Hi, everyone. Thank you again for joining us over your lunch hour for another one of our WESC webinars. My name is Ali Ramsey. I am WESC's Executive Assistant and Communications Coordinator, and I'm so happy that all of you are here today. Our topic today is business budgeting and cash flow tips, and it is presented by Renee Lawrence of Virtus Group. So if you have any questions at all for Renee, please go ahead and put those in the Q&A box. There is also a chat box. If you want to use that to introduce yourself, tell us your name, what company you're from, please go ahead and do that. But if you have any questions, just go ahead and put those in the Q&A box below. And as always, this webinar is going to be recorded and it will be available for on-demand viewing on our website. You will receive an email tomorrow with a link to the recording. And with that, I am going to stop sharing my screen here and I am going to pass it over to Renee.
Hi, everyone. Thanks for joining me today. I will open up my slide set here if this works. There. All right. You guys should be able to see it. So that is great. Okay, so today I'm just going to be talking a little bit about cash flow and how your business can budget for the cash flow that you're generating. Talk about a little about what cash flow is, and just maybe give you a few tips to help that cash flow stay in a positive position. So, and like Ali said, feel free to post questions in the chat boxes. I'll try, if there are any, to touch them throughout my presentation, but if I don't, I will take a peek at them at the end and try and answer them for you. So to start, what is cash flow? So cash flow is movement of money in and out of your business. So a lot of people tend to think that cash flow is tied to their profits. So it's a little bit confusing, but even though you might have a profitable year, does not mean that you have positive cash flows. So I have a little story I'm going to walk through. Hopefully this can just kind of set an image in your mind of exactly what cash flow is versus profits. So let's use an example. So let's say Susie has a lemonade stand. So year one, Susie is going to open up her lemonade stand. Her dad says he's going to give her $10 he'll loan her $10 to start the lemonade stand. So to start the year, Susie has $10 of cash flow into the company. The terms are, though, that she has to pay her dad back that $10 the next year. So year one, Susie has $10 of cash flow in. She has sales of $10. So now she has total cash flow in the company of $20. And she buys supplies of $10. So her cash outflow is $10. So net together, her total cash flow, $10. But if we want to look at Susie's profit, she only had sales of $10. She spent supplies of $10. So she actually has a profit of $0. So that's a really good example of how her cash flow was a positive. She had a positive $10, but she actually had a profit of $0 because that $10 she got from her dad isn't profit. She has to pay it back. So that's the difference there. So then in this same example, where people can get in trouble is in year two. Now Susie has to pay that loan back to her dad. So if we assume that sales and supply costs stay the same, Susie has sales of $10, so cash inflow of $10. She buys supplies of $10, outflow of $10. So her profit is $0 again, but she owes her dad that $10 back. So she somehow has to pay that back, and she actually has a negative cash outflow of $10. So that's just a little example in simple terms of how profit and cash flow are different. We'll keep walking through, talk a little bit more about what cash flow is, how it's generated, and things to watch for. All right, so where does cash flow come from? So I have a few different slides that look like this, and they just kind of get more in depth. So we'll start with the basic, and then we'll kind of keep digging deeper into them. So customers and sales are usually your main source of generating that cash in. So you have your customers, they come and purchase your products from you or your services. Now that either can turn straight into cash or it goes into accounts receivable. And we'll talk about the importance of accounts receivable and things to watch for there if they take that route. So those sales come in either as accounts receivable or cash, and then you turn around and spend that cash on inventory to eventually generate more sales. So the cash flow really is a cycle. It can be a vicious ring that cash, you need that cash to generate more sales. So that's why it's so important, because we can see that sales ties right back into itself. So if your cash flows aren't positive, it makes it harder to continue operating year after year, because you need that cash to continue to generate sales. So here's kind of that spreadsheet just in a little bit more detail. So customers, they're the sales. You have your geographical area of who those customers are, and you have your specific product or customer that you're focusing on to generate that cash. So then we look into accounts receivable. Now if you do have accounts receivable in your business, you should have it broken down between how many days it's outstanding. This is super important because the money owed to you is essentially tying up your cash flow. So if someone is owing Susie money for her lemonade and aren't paying her it, she doesn't have that cash to pay her dad back. So generating that accounts receivable into cash is super important. So knowing how many days it's outstanding helps to know when you should be collecting. So once you hit that 90 to 120 day mark is really when you need to focus on collecting those receivables. And I'm getting ahead of myself because I'm going to get into that later, but so that's when cash is in receivables. Other ways to generate cash, so your sales are your main source, but marketable securities. So when you get to a point where your business does have excess cash on hand, a great way to generate more cash is to put it into the stock market or even savings accounts that generate interest back to you. So then that cash comes back to you as interest and dividends. So that's just another source of getting cash flow. Then you also can generate cash through, bank loans, short-term lenders, non-bank lenders, right? So family or friends that would like to lend money to you, sometimes a little bit harder, and maybe not, you don't want to deal with them as much, but those are other options. So you have to remember too, there's positive and negative ways to generate cash, and debt is not always a bad thing, but you have to make sure that you are going to have the ability to pay that debt back, right? So, gaining debt in year one, in our example, in Susie's example with the lemonade, it's great. So in year one, her debt was positive cash flow, but in year two, it ended up being a negative cash flow for her. So it's just making sure you have the projections, knowing that you have the ability to pay off that debt that you are generating. Other ways that cash is spent, so cash outflows. So taxes is one. We're going to talk about that. You can't make money and not pay taxes. So lots of people get caught with that, just not having the cash flow to pay those taxes at the end of the year. And then you need that cash to pay for the materials, the supplies, your wages, anything that is directly involved with the sales of your product or your services. So you pay those expenses, and then you're going to have to pay for your inventory and the materials to produce those products. So again, it's that cycle of the cash comes in, other ways to generate cash, and then ways that the cash goes out. All right, so a few components of cash flow. So we talked about inventory a bit. So here's just some tips and things to watch for in kind of each of the boxes that cash goes in and out. So inventory on hand. So when you start a business, this is going to get easier the longer your business operates, because you're going to have a better understanding of what you need on hand. But it's very important to be watching your inventory and watching your inventory turnover. So you really don't want your inventory sitting on the shelf for longer than it needs to be. So projections are a great way, right? Projecting what your sales numbers are going to be in the year and how much inventory you need on hand. to fill those sales. A question you might have is, well, doesn't it just make more sense to have more inventory? So if a client walks or a customer walks in and needs something and I have it, I can have that sale. The problem is when you buy that inventory, it's tying up your cash. So you don't want to go spend a whole bunch of cash to purchase inventory and then have that inventory sit on the shelf when you could have had that cash in your pocket and using that cash to generate other revenues for you. So that's just something really important to keep in mind. Make sure you're watching your inventory turnover, calculating those ratios and making sure that it's turning over quickly. It also may make sense if you have inventory sitting on hand that you just aren't using. You can write it off your books just to make sure that it's not creating a false image on your balance sheet. Or even you can look at discounting it just to get it off your hands. Some cash in your pocket's better than none at that point if you're never going to sell that inventory. And then there's also progress invoicing. So possibly an example could be if you are someone, say, that does construction and you're using inventory throughout the build, you could progress invoice throughout the build to get paid back for the inventory you're using. So that's also another option. All right, so next we'll look at accounts payable. So this is one where it's obviously opposite of receivable. So the longer that we have payables on the books, the more cash that we have that we're not spending. But you also have to make sure that you have good payables terms and you're aware of what you can have in payables. So I'm just having terms and arrangements in place with anyone you can that can have payables. So you want to make sure that your payables and receivables balance. So what you don't want is your average accounts receivable terms being 120 days. So you're not getting paid for 120 days, but your payable terms being 30 days. So what's happening is essentially you're paying your payables before you're getting your cash in. So knowing what your terms are and arrangements are, just to make sure they align with what your receivable terms are. Also making sure that if you are purchasing large volumes or dealing with one supplier, that possibly you can get discounts. That's a way to help your cash flows, right? Spending less and just knowing what your supplier's terms are and what they're willing to do for you. And then lastly, government agency payments. So those always have to be paid first with accounts payable. Technically, they're supposed to be. Any money is owed to the government. And we're going to talk a little bit about knowing, knowing what tax you do owe to them, making installments to make sure you have the cash and the ability to pay those bills. All right, so the next we've kind of touched on a bit, but collection of cash and accounts receivable. So this, here's a few things to just kind of help those accounts receivable get off AR and into cash. So preparing invoices promptly. So make sure you are invoicing your customers regularly. It's a lot easier to collect for something that a customer remembers that you did for them if you're a service provider or that you provided for them versus invoicing them 6 months down the road for something. It's just going to create more time and headache, and really you don't have that cash in your hand to generate more cash from. So making sure you're invoicing fairly regularly, possibly have a policy in place or a plan in place for when invoices are going to be done. Create credit terms. So make sure, you just don't have, you're not allowing customers to just pay via accounts receivable and they have no timeline in place of when they should pay back the cash. Also, if you do have like a line of credit out or long-term debt of any sort, it does make sense to have credit terms in place to charge interest on late accounts receivable. Essentially, your customer should not be making money off you. So if you have a loan out, if you're paying 2% on a line of credit or a loan because you don't have the cash and your customers aren't paying you, you technically could charge them that 2% to net out the difference, right? You're having to loan cash out because they're not paying you. So that's also something to keep in mind. And down payments is another good one as well. So if they can't pay their full bill at once, getting a down payment to ensure at least a portion of it or some of it will be collectible is also a great idea. All right, so another nice little chart here, just getting into even a little bit more detail. So this one is just really highlighting inflows of cash and outflows of cash. So the different options. So your operating activity. So this is really your main business activity when you create those sales. So the cash inflow is when you actually receive the cash, though, not accounts receivable. So if you, we can go back to the example of Susie. If she sold $10 of lemonade in the year, but it all went to accounts receivable, she could show profit at the end of the year, $10, but her cash flow is zero because she actually didn't get paid cash. It's sitting in accounts receivable. Investing activities. So we haven't touched about this yet, but other terms of cash flow. So if you have property, plant, and equipment, so machinery, supplies, furniture, any of that that's sold, and you get cash for it, that's actually a cash inflow. So that doesn't directly affect the profit of your business, but that is a way that you cash could be brought into the company. If you're getting rid of any debt or equity securities of any other entities, if you're collecting on loans to other entities. So if other entities owe you money, if you've invested into another company and they're paying you back, that's all cash inflows to you. So again, those activities aren't directly profit to your company, but it's cash owed to you. And once you get it in your pocket, that just increases your inflow of cash and your cash flows. So financing activities. So we touch on this. So other ways is essentially to bring on debt. So getting bonds, equity securities. This is the place you need to watch though, and you don't want to get in trouble. So I'm not saying it's not bad, right? You know, the good old saying, you need money to make, or you need to spend money to make money. So you're going to need cash to make money, and obtaining it by debt is not a bad thing. However, you just need to make sure that you aren't in a place where you're getting on too much debt that you can't pay it back. So it's just, we'll talk about this later, but it's just creating cash flow budgets and knowing what your company can handle. So then ways that cash goes out of the company. So if we look on the bottom left-hand corner now, so pretty much the opposite of the inflow of our operating activities, the outflow is the direct expenditures related to creating our profits. So again, these are when we actually pay our vendors. So if we have a bunch of stuff in accounts payable, that's not actually a cash outflow. And again, tax payments. So if we, opposite of tax collections, so tax collections, an example would be if GST, if we have a GST refund in the year, the opposite would be if we're owing GST. Or, you know, corporate tax payments if it's in a refund position versus a payment position. Investing activities, so more common, the property, plant, and equipment we're going to see as a cash outflow, right? So purchasing, you know, buildings, you know, doing leasehold improvements, furniture, equipment. We see that more as a cash outflow, especially because those items depreciate. So when we do sell them, it's usually because we're replacing them, right? So trade-in. So for example, if you purchase a truck, likelihood if you're selling that truck, you need another truck to replace it. So that is just being traded in, and it's not really a cash inflow. It's just helping you to fund your next purchase of the asset. So we do see that's an important one to remember as well, because purchasing PP&E is not going to show up on your income statement. So again, you could, in our example with Susie, for example, if she purchased a lemonade stand for $20, it's not going to show up as an expense on her books. It's showing up as an asset, but we need cash to fund that asset. So just looking at your bottom line that you had profit in the year of $20, you might have bought a piece of equipment for $20 and now your cash flow is at zero. So outflows as well. So once you get into a point of when you do have enough cash in your company, you don't want that cash to sit. So purchasing securities, loaning to other entities, you know, if they're going to be generating interest or other cash inflows to you are positive things. It's just another source of income to you. So that's why cash can go out of the company. Once you're at the point where you have enough cash, there's nothing wrong with finding other ways to flow cash out. That's going to turn into bringing cash in for you. And then lastly on here, we have financing activities for the outflow of cash. So payment of dividends. So this is one to watch. Dividend payments are usually made out to owners of the company when cash flows are positive, just to fund them a little bit excess cash if they're not in salary, to get them personal cash in their pocket. You have to watch as well because you don't want to get in a spot of paying out dividends when the company doesn't actually have cash. So this one's really tough because business owners do work very hard in their business. You know, they're not working 8-hour days or 10-hour days. They're working 14-hour days, 16-hour days, 7 days a week. Even when that, you know, that mom and pop shop isn't open on Sundays, I guarantee the business owners are in there doing something, right? Stocking inventory, doing bookkeeping, whatnot. So every business owner does deserve that dividend payment at the end of the year, but you have to watch because if cash flow is not there, you might just be getting yourself in trouble, right? You don't want to be taking a loan out to pay yourself a dividend when personally you might not even need that money. So it's just knowing what the company has for cash flow and what they can make for dividend payments. And remembering that if you are in those startup phases where you don't have a ton of cash on hand, it does make sense sometimes to just leave that money in the company and, you know, invest it there to help the company grow versus taking it out personally if you don't need it personally. So other outflows of cash in the financing. So redemption of debt. So if you did have debt, paying that back, right? You always have to pay that debt back. So that's going to be an outflow. And reacquiring capital stock if you had any in the company as well, paying out those shareholders. All right, so the next question is, okay, so now I'm telling you inflows and outflows of cash, but essentially how are we going to manage it, or how is your business going to manage it? So one of the most important ones is creating a cash flow budget. So this isn't just projecting, you know, sales for the year and what sales are going to cost you, right? But it's really looking at any sources of cash coming in or out of the company. So a really basic budget would be you take your beginning cash in the bank and all your inflows of cash in the year. So if I go back a slide, so you're going to look at anything that you think you'll have for cash inflows from that top section. So you can estimate what your sales you think are going to be. Possibly you are planning on selling a piece of equipment and not replacing it. You might be planning on taking out some debt. So those are all cash inflows. Then you'd want to look at your cash outflows. So what do we expect to go out? So you would, of course, have your fixed costs and variable costs. So, you know, your fixed cost, what your rent is going to be for the year, what your utilities will be, salaries. So you already know what all those expenses are. So you can throw those down. Then your variable cost is going to drive based on what you're projecting your cash inflows of sales to be. So you would account for those as well. And then you would also account for any other expenses. So this is where it gets tricky. Sorry, not expenses, any other cash outflows. So again, are you going to buy more equipment? Are you paying off loans? So any loan payments, if you have current loans, you really need to know what your loan payments are going to be for that next year to make sure you can fund them. Taxes is a big one. So if your company's profitable, if you're a small business and you're operating with net income less than $500,000 right now, the tax rate's 9%. So if you make $100,000 net profit in the year, your company is going to owe the government $9,000 in taxes. So you need to make sure that you have that cash on hand. So if we go back here, so preparing that budget, just knowing, having in your mind, knowing what your cash flows are going to be. And then a lot of times too, after you figure that all out, then you can see, is there excess cash to pay out a dividend to the shareholders in the year? So it just helps you plan for the year, and it'll help you to get in a spot to make sure that your cash flows are positive and you're not getting in trouble with negative cash flows. So the next thing that will help manage your cash flows is knowing your cash requirements. So preparing that budget should help you. This can also play into how much cash do I need to keep on hand? And I think I talk about this actually in the next slide. So we'll pop to this slide and then go back. So knowing what you need for cash flow, I would recommend having about 3 to 6 months of overhead activity costs on hand. So all those fixed costs, you want to have to about 3 to 6 months of that cash easily available on hand. Once you get over that point, that's when you want to consider putting that cash to work. So one thing that I see with clients a lot is they'll bring their books in and they'll have like $100,000 of cash sitting in their bank account, and let's say their yearly cash expenses are $40,000, right, for the year, and they're continually throughout the year they're continually generating more cash. So having that $100,000 of cash in the bank is probably excess. So that's where we really stress it's important to start investing that cash, putting it to work. Maybe you want to grow your business more because that cash is really doing nothing for you sitting there. So it's important just to, at that point, think of how you're going to invest that further. So it can be as simple as, investing it into bonds and stocks. Some people are less risk averse, so it could just be putting it into a GIC. It's still generating some excess cash for you. Also, with cash on hand, you want to project any large future expenses. So if if you're a restaurant and your freezer is going to go any day now, if you know that freezer's $10,000, it probably makes sense to have an extra $10,000 of cash on hand. So if you are at that point where you are starting to stock cash away into investments, or you want to pay it out as dividends, just knowing that you might have that big expense coming in the future makes sense to just maybe keep that extra 10 grand on hand because you have that expense coming. And one other thing, which I talked about before, but make sure you know what those loan payments are for that next year, because you're going to have to cover those loan payments. Those essentially aren't going to come out in your fixed costs. So making sure you have enough cash on hand for that. But it is really important to make sure you aren't just, once you get to that point, it is a good problem, but you're not stockpiling cash, because cash can make cash. So why not if you can? All right, so then seasonal fluctuations is also a really important one to remember as well. So for example, if you are let's just say Johnny cuts grass in the summers. So little Johnny, charges $20 a house to cut grass. I have no clue if that's a reasonable price or not, but if he's cutting grass only from, our summers here don't start till like July, it feels like, but let's say he's only cutting grass for 4 months of the year. It's knowing that that cash has to provide for him the other 8 months. So focusing on that, and when you're making your budgets, keeping that consideration into mind. So not every business doesn't have seasonal fluctuations as dramatic as that, right? That's going from completely having cash to no cash. But there tends to be fluctuations, the holiday season's the time of year where possibly if you our retail store, your sales would increase then, right? People are out buying gifts for that time of year. So just knowing those and being able to budget for those as well. So maybe you don't, you may have the ability at that time of year to spend more, right? Maybe that time of year is when you buy that, extra shelf you need in the shop because you have the extra cash on hand. So keeping those in mind. Capital expenditures we talked about, right? So that's buying that property, plant, and equipment, those one-offs, those large amounts, being able to try and forecast for those. So contingency plans. So I hate saying the word because I know we're all sick of talking about it. But the pandemic the last couple of years is a great example of this, right? We obviously can't forecast for things like that, but just having a contingency plan in place with possible risks and mitigations, right? So, there is the potential that, so back to the restaurant example, our freezer goes on us. We need a plan in place of how we're going to get that cash to replace it. So just keeping that top of mind and having plans for that. Financing is a great option to manage cash flows. So just knowing what financing options you have to you. Sometimes even it might make more sense, even if you have cash to finance things, you can get 0% financing to get a delivery van for the company. It actually might make sense to finance something so you have that cash available to purchase more inventories, things like that. So this extra surplus of cash we also talked about and touched on. So make sure you're putting that cash to work when you do build up that cash balance. That cash can make more money for you. I can't stress that enough. So when you do get to that spot, make sure you're dealing with that surplus. And then the last point is also very important. Make sure you're continually analyzing that budget. Things change every single day. We might not even be aware of it. But if you make a budget, and also look at that budget, right? So if you, after this, session today, say, okay, the new year's coming, January 1st, I'm going to make a budget. And if you make that budget and never look at it again until the next January 1st, when you're doing the next year, and that budget, you're wasting your time because it's not valuable to you, right? So if you make that budget, make sure you're looking at it on a monthly basis, bi-weekly basis, to make sure things are on track. That budget also could change throughout the year. If you make that budget in January and in March, you realize that you're going to need to replace a large piece of equipment. By all means, it doesn't hurt to, forecast, change your June budget to see if you do have the ability to spend that cash. So keeping those budgets top of mind is also very important because if you make them and never look at them, they're really no good to you. All right. Oh, I'm flying through. That's good. You guys will have time to enjoy your lunch. Okay, so some frequently asked questions that do come into play. So I touched on this at the beginning. So why do I have tax to pay and no cash? So this is kind of the same situation as with Susie and her lemonade stand, right? She paid her dad back her debts. Or the first year she had profit but no cash. I can't remember now. So if you guys have ever been employees, or if you are an employee, the government makes it easy on us, I should say, where so I'm an employee, so every month when I get my paycheck, my taxes are taken off of it. So when April rolls around, I don't have a big tax bill to pay. Companies, the first few years where they make money is where this really affects them. So companies are not required to pay tax or prepay tax until they owe over $3,000 in tax. So if you're first year in the business, your business is break even, doesn't pay tax, you're not going to owe anything to the government. In your next year, if you owe $4,000 in tax, so say you had $40,000 of net income, we'll use 10% tax. If you owe $4,000, now you need that cash. And what they're going to do is they're going to require you to make installments based on that $4,000. So throughout the year, you would make installments. So making those installment payments helps because just like an employee, you need to make those payments monthly. So it helps to know that you have the cash on hand. But what happens is if you have a loss one year and a bunch of income the next year and you weren't required to make those installments, you might have a big cash tax bill to pay. So just if you're doing budgets, I would budget after net income. If that number's fairly correct, I would budget about, for a small business, active income, 10% would be kind of what you want to keep on hand for taxes. That's what I would keep to owe at your year end. And then another one is, how do I pay off tax or debt obligations when I have no cash? So this one's tough because now we're talking about how do we generate cash. So this is when we go back to that one of those first slides with the charts about what are options for cash inflows. So here it would be, look at your accounts receivable. Is there anything you can collect? Are you ordering too much inventory? Do you have too much inventory on hand? Maybe this one you're paying off tax and don't have debt. So maybe it's just acquiring a little bit of debt to get that tax paid off. But the biggest one here is if you do that budgeting and just making sure that those cash inflows can stay positive and knowing what that tax bill is going to be. So again, it's hard because profit and cash flow do not equal each other. So yes, you can owe taxes because you may have made a profit, but you may not have cash on hand. So I do have clients as well that they just, in their mind, keep an extra, bank account on hand that they transfer, what they think they're going to owe in tax every month, just so at the end of the year when they do owe that tax bill, they do have it. So there's different options for what you can do, but it's just making sure that you know that you will have to pay tax on any profit, and it doesn't mean you're going to have the cash on hand. And then what do I do with excess cash? We had already talked about that. All right. So just a little bit more about the importance of cash flow budgeting and projections, and then just kind of things to watch for and things that can possibly help with it. So a difference between a company that succeeds and one that fails is often cash management. So I've talked a lot about how cash generates more cash for you. So if you don't have positive cash management, likelihood that you're not going to be creating a ton of cash and the company's not going to succeed. So businesses typically do take on debt, and it is important that you have cash flow projections to provide comfort that that debt can be repaid. So I also touched on that too, right? Debt can be healthy. So it's just knowing that you do have the ability to pay that back though. So if you have too little cash flow, it means that you can't deal with the unforeseen circumstances. So that's the example of the freezer blowing up on you, and you need a new freezer, right? You couldn't see that coming. Having to pass on profitable ventures. So this example could be if this is an extreme example, but if you're a restaurant and another restaurant is offering you to buy them out, if you don't, it could be a great opportunity, but if you don't have the cash, you can't do that. So that could be an option, or that could be another reason why, or what negative cash flows can mean to you. Having too little cash flow might also mean that you're having to increase loans to overcome liquidity issues. So if you can't liquefy your cash, so if you have too much cash sitting in accounts receivable, you might need to increase your loans. And really, in the end of things, if you don't have cash flow, it's going to reduce the value of your business, which you don't ever want, because businesses are babies. I know that, right? Business owners, their business means everything to them. So, and you, like I talked about, you put so much work into it. So you really do want your business to have a value at the end of the day. All right. So some important considerations for those cash flow budgets or projections. So make sure that your current financing remains viable. So make sure that you do have it. So do you possibly need to increase that line of credit? you might not need it now, but maybe it, things are getting tight and it might make sense to try and get that line of credit increased, just in case you might need it, right? And, for how much and how long. So just making sure that you will have it for the period of time you need. If cash is getting tight, you can always reconsider variable costs. This is a big one. Like I said, in the last 2 years, cash flow has been tight for a lot of people. We've seen this a lot with clients. It's very unfortunate. So it's just working with them on, where can they cut costs. So start looking, first spot to look is your discretionary spending, right? So entertainment, travel, meals, maybe you used to do, you might have traveled to Banff for a weekend for a PD course, but now you can do that PD course virtually. So now you can save your, those travel costs. Entertainment costs, do you really need to be, taking customers out to the Rider game, once a month, right? So it's tough because those costs like that do have value. I'm not going to say they don't, but when things get tight, those are the costs that you're going to have to start looking at. Reducing labor possibly. So, making sure that the staff you have are busy. Do they have redundant or obsolete tasks that maybe they don't need? So salaries is also a really big cost to companies. So that's something that you might need to look at. And then in that case, it's, do you possibly have to reduce hours? Some other places to look. So revisiting your capital investment plans. So looking at, purchasing that property, plant, and equipment. Do you really need to? Is it important? You might need to. It might create a competitive advantage. An example would be, let's think of, the big stores like Walmart's or superstores. When self-checkouts came into place, did that create a huge competitive advantage? So, that probably took up a lot of cash, but it might have actually generated more cash because it put them at a better spot in the market. So again, your investment plans for capital, looking at those, what do we really need? What's important? Is that new truck I was going to purchase needed? Maybe we can push it down the road a couple of years and use that cash in a better spot. And then also too, cash flows are tight. Is there possibly new markets, new products, new ways to distribute that could help generate cash, right? So, online versus in store, what are other people doing? And one thing here, it's really hard to do, but it's being proactive versus reactive, right? So if your top competitor has already done something, going and reacting to that and doing the exact same thing isn't going to have the same effect. So, constantly just focusing on your revenue streams and just, is there anything else that can be done, or can we make this better? Or, is there something else that our customers might want to see? So just looking at that as well. I should check. I'm hoping there's been no questions. I don't know. Nothing's popped up, but I'll look after. We're almost done. So lastly, looking at fixed and variable costs where possible, right? So little accounting 101 here. So fixed costs are things that are not directly tied to sales. So you could have 0 sales in the year, but you still need to rent your building. So that's a fixed cost to you. A variable cost is one that's directly tied to your sales. So for example, if I'm selling, I don't know, books, for example, I have to order in the paper to bind the books together. That paper is a variable cost, right? The amount of paper I'm going to need is going to be dependent on the amount of books I sell or books I need. So that's related directly to the product. So the fixed and variable costs. So a lot of these, again, some of these have come up from in the last 2 years, but maybe if more staff are working at home now, you can reduce your building space. So maybe that decreases your rental costs. Maybe you have a huge space for warehousing, but possibly you could get that done third party, so you don't have those warehousing costs as well, or even shipping, right? You could third party that out and make those variable costs instead of fixed. And then lastly, we touched on this a little bit, but the cash going out to shareholders or owners. So if you don't have the cash flow there and you're still taking out dividends, are you possibly taking out a loan to fund your life or pay yourself? So with business owners, it gets to the point where you want to leave as much cash in the company as possible. So it's just making sure that you're only really taking out the cash that you need. And especially if your cash flow is tight in the company, you might need it in there more. So just making sure you're taking out your personal spending needs because you want to invest that cash back in the company. So that is all I have. I feel like I talked through that really fast, but it is already almost 12:50. So we do have time if there's questions or anything. It's a really broad topic, so I just tried to cover kind of everything and give you guys just a general basis for what cash flows are. Okay, so I do have a question. Are there any programs that you recommend that help prepare an annual cash flow budget? That's a really good question. At top of my mind, my first thought was just an Excel. I know that we do a lot with QuickBooks Online. I would look into that. QuickBooks is a great program. They all are, all the accounting ones, but that one might have an aspect to it that could help you. I'm not sure what you use for your, I'm sharing my screen. I'm not sure what you use for your accounting software now, but what you're using now might even have something that could help. So depending on what the costs are, you could even start just like with a basic template in Excel. It's not going to cost you anything to just figure out what those numbers are. But that's a good question. I don't have a great answer for you on that, but I would start with whatever software you're using now, see if they have a possible template, possibly see if maybe QuickBooks has something that you can use. And yeah, that's an answer to that. Any more questions or anything else? Comments, thoughts? All right.
It looks like that's all the questions. If anybody has any other questions, feel free to pop those in. But just a reminder that you will get a copy of this recording tomorrow in your email, so watch out for that.
And also, Ali, sorry, I just want to just let you guys all know, feel free to contact me. My email's up there. Our office number's up here if you guys have any questions. Even if it's not on cash flows, anything else, I'm always happy to help. So feel free to shoot me an email. I'd be happy to, any questions that come up in the future, I'd be happy to help.
Perfect. So if you think of anything else, write down Renee's email there and you can reach out to her. So thank you so much, Renee, for that presentation. It was really informative. We really appreciate it. And thank you to everybody that came out and gave up their lunch hour to come hang out with us. I appreciate that as well. And as a reminder, you will get the recording of this presentation tomorrow. And our next webinar is next Wednesday on branding in the early stages. So if you haven't registered for that already, please do so at west.ca/events. Thank you again, everyone, and have a great rest of your afternoon.
Thanks, everyone.